We are talking about the federal budget just announced the other night. We are joined today, joined by my colleagues, Suzanne Crichton. Suze is one of our partners in our tax and compliance division. G'day, Suze. Thanks for joining us.
Well, good to be here.
And Josh Robertson, also a partner, one of our partners in our compliance division, tax and structuring. So welcome to you too, Josh.
Good morning.
We're going through just a little bit of housekeeping. Today is part one. So we're going to do at least two, probably more of these sessions. You probably all know we don't have legislation yet to speak to in terms of the detail of what is potentially unfolding in this space. So today is going to be more about what has been announced and the detail that we have at hand right now. But it's really just part one. So it's a lot of background and information based on what's already been announced. As I said, please put your questions into the chat. If you're comfortable to, put your question in for everyone to see. We will not be able to answer all the questions today for various reasons. I'm sure probably some of them are going to need further research, and we won't have the detail. What we will do though, and we might actually not have time to, we have a hard out at 11 o'clock today. So what we're going to do is we will take the questions from the chat and we'll turn it into an FAQ afterwards, and we'll send that resource around. So if you do have a question, please put it into the chat. If we don't get to it, that's okay. We'll come back to it in our FAQ that we'll release. We'll release that along with the video. So we're going to have a video. We always release a video after the event, and any resources that we talk about as well. We'll run some polls, just a couple of polls. One of those at the end will be, if you do want a consultation with us, you can use the poll to do that. So hang on for the end for that. I'll do a shout out as well for our Xact resources page. So if you don't, if you missed the email where we send the replay out for the event, you can always go to our website. There's a resources page on our website with calculators and blogs and replays of events, all of that sort of good stuff. So go along to our website, to that resources page. There's a lot of good stuff there. Our agenda today, so we're going to cover the main changes that are occurring in the budget announcement as they relate specifically to building and construction. So if you're not from building and construction, you will learn some stuff today, but really this is mostly for business owners, those trying to navigate these changes in the construction space. Discretionary trusts, stamp duty changes, negative gearing, and CGT. They're the main changes that we're going to see through this budget announcement, along with some other announcements around write-offs, the loss carryback arrangements, and there's some changes to the apprentice system as well. So we'll cover some of those, and then we'll finish off with a bit of a timeline and some framing about, I guess probably more than anything, when do we need to care about these changes? And when are we going to have some more detail around those changes so we can speak to things in a more tactical way? Okay, just quickly, if you don't know anything about Xact, we have four main services we offer. Tax and compliance, which is, Suze and Josh are representing that division, that service line for us today. All about structuring your business so that you can get the best possible outcome from a tax perspective, but also when you're wanting to protect your assets too. And in building and construction, the high risk nature of the work we often do, it's really critical that you have that structure right. Bookkeeping, we offer an outsourced bookkeeping service. These guys know all about Build Xact, One to Build, Build a Trend, Procore, all the rest of it. And they know how to help you job cost. And more than anything, it's great to have a specialist who knows what they're doing and that you don't have to do it yourself or try and find a really good bookkeeper. So that's our bookkeeping service. Over the top of that, we have an advisory team who offer a financial control service. These guys do the end of month reporting for you. So they'll close out the end of month. They'll do all the journals. They'll calculate your WIP each month, all of those sorts of actually quite tricky things when it comes to crunching numbers in construction. They'll produce that monthly pack for you and provide advice along the way. And ScaleX is for businesses who want to grow either the top line or the bottom line, and a partner to do that. Okay, that's enough of that. We're going to do a quick poll. So I'll just bring up this first poll, and it is a pretty basic one. And it is, in terms of the budget changes that have been announced, what change are you most worried about or concerned about? So we've got trust reform, negative gearing changes, CGT changes, and I'm not sure yet. I want to know what's going on before I want to answer that question in any more detail. So it's a reasonably even distribution here. I might just end that one now. I'll share those results. So we can see it's trust reforms out in front. Not surprising. Trusts have been a vehicle that have been used not just in construction, but really across the economy for quite some time now. And these are what look like being really quite substantial changes. So I'm not surprised that that is on everyone's mind. Those other changes are quite pertinent too. So we'll be covering off on that. Okay, I'll stop sharing that and we'll go back in now. So we're going to kick off just quickly. This is general information as at right now, as far as we know, in terms of what's going on in the market and with these changes. If you are going to make any decisions at all, please get advice that considers your specific circumstances. You probably need a really good accountant, and you'll probably need a good lawyer as well when you're looking at things like trusts and structuring. So please get that information from an advisor before making any decisions based on anything we've covered today. Okay, Suze, that's enough from me. Let's hand over to you, and we're going to cover trust. So we're starting right in at the business end here, and we're going to talk about some of the biggest reforms we've seen for quite some time. Over to you, Suze.
Thanks, Phil. Yeah, trust is one of the bigger targets in this budget that's just been announced. Quite a few different things being suggested that are potentially coming into play. The main one being this minimum 30% tax on trusts. What we know at the moment is that that's only going to kick in from 1 July 2028. So we effectively have 2 years from now before this starts. That means that any structures currently in place, nothing needs to change. Everything will just be business as usual for the next couple of years. Having said that, there is an opportunity to potentially restructure. We're not quite sure what the government's offering in that space. We're waiting to see more information from them around how that's going to look. And they're suggesting we'll have a 3-year window from 1 July 27 until 30 June 30 to be able to restructure out of a trust and into something else. What that looks like could be potentially a restructure into a company. It could be a restructure into a fixed trust, or it could be that we choose not to restructure as well. So there's a couple of options there that we might have. One thing to note is that this 30% minimum tax, and we're going to go through an example in a moment of how this may work, but one thing to note is that it's going to be a non-refundable tax to beneficiaries. So that means it's going to be a flat rate paid at trust level, so the trustee will pay that tax. When it flows through to the beneficiary, it's going to be non-refundable, but will always sit as a 30% tax. You won't get any credit like we do currently with franking credits out of companies. That won't apply in this situation. There are a few trusts that will be exempt. So self-managed super funds will be exempt. Testamentary trusts, the government has announced that existing testamentary trusts will be exempt. We're unclear exactly what that means for any that are sitting in a will at the moment, but the person hasn't actually passed away, so the trust hasn't started effectively. So we're still up in air about that. And primary production will generally be exempt as well. So there's a couple of things sitting in there that we may be able to impact or play with, if you like, around some of these changes that are coming through. Income splitting out of discretionary trust is obviously going to be reduced. And the main reason for that will be the 30% tax coming through. It means that, and our example will show this in a moment, it means that where we've previously been able to share income between, say, mum and dad, we might have some restrictions on some of that, or the alternative, which is the bigger part, we won't be able to get all of those tax credits back into the hands of mum and dad. What that means for everyone on here today is potentially we're going to have to consider a restructure. And as I mentioned, the government has said there will be a 3-year window that we can look at doing that, but we don't know what that's going to look like yet. We don't know how it's going to operate with existing rollovers and restructure relief we've currently got in play, like our small business rollovers or our 122As, or inserting other structures into a structure. So we've got some things that we'll have to think about. And as I said at the start of this, we do have a 2-year window between now and 1 July 28 to be able to review existing structures and the impact of what these rules are going to have, and whether we do restructure or whether we don't. And there may be situations where it's more beneficial not to restructure. So everything has to be looked at case by case. It's not going to be a blanket one answer fits everyone scenario. It will, as we said, impact operating businesses. It will impact investment trusts as well. We need to consider how they play out and what they look like. So yeah, lots of issues in this space. And we do, as I said, have time to think about it, have time to plan for it. It's more just a case of starting the conversations earlier and waiting a little bit until we've got a bit more information about how it's all going to play out to know how it's going to impact most people.
So one of those areas, Suze, you've just discussed there is this whole idea of the income streaming piece. It's a I guess a tax tactic that many have used, particularly we find in construction. I know this sounds like a bit of a generic response here in terms of the structure we've got on the screen here, but we do come across this fairly regularly, where you have a husband and wife in the business one way or another. But the husband's, on the tools and generating, usually a fair bit of income as a result. And then a wife who is maybe partially in the business or maybe not involved in the business on a lower income looking after kids. Again, we're being generic here, but this is a common example that we come across. So maybe if we can just talk through the impact of these potential trust changes in this lens.
Yeah, for sure. So as Phil said, this is a structure that we commonly see, particularly in Queensland. We'll have a trading company in play as opposed to a trading trust, but the same principles really will underlie what is going to happen with trading trusts as well. The trading company will keep the trading operations unique, and then we'll push profits through down into a holding company. And that's where we might then either utilise investments from that perspective or push cash back down into the family. The holding company and the trading company pay tax at the same rates. So there is no difference in terms of the tax between those two. It sits at 25% for small business entities. When we're ready to push profits out down into the family, we would then pay dividends from the holding company down into a discretionary trust. And this is the side of things where it will change. So where we've got a family trust receiving those dividends, that family trust is now going to be taxed at 30%. So the holding company, the trading company are taxed at 25%. Suddenly the trust is now paying at 30% or a 5% increase. Our understanding of how this is going to work is that the trust will get the benefit of the franking credit coming through, but the trustee will have to pay that additional 5% amount to get them up to that 30% minimum tax that the trust has to pay. Once the trust then wants to or has to distribute that through to family members, and in this case, we've designated husband and wife, that's where that tax will carry. So you'll get that 30% tax through down into your individual tax returns. But if you're paying tax at, say, a 20% or 16% tax rate, if you're down in those lower brackets, you will actually lose the additional 10% odd that comes through with that credit. So that becomes a lost tax. So you're paying a minimum 30% regardless of whether your tax rate is up at 30 or more or is below 30. And the example on the next slide, we'll just work through some actual numbers. So in the current rules, if we've got a trading company that earns or has a taxable income of 100,000, you're paying tax at 25% or 25,000 of tax. The holding company will then push the dividend through down into that. No change in terms of what the tax is there. The total income coming through down into the trust, we have 100,000. And at this point, both sides are the same. So at this point, the trading company, the holding company, even down to trust level, nothing changes under the new rules. At trust level, we've now got 100,000 of grossed up income. So the 100,000 of taxable income that's already been paid by trading company, and we've got a 25% credit, $25,000 credit coming through. Once we get to tax level under the current rules, nothing changes. The distribution goes straight through to the wife, and in this case, we've said 100% to the wife, and we've assumed she's got another 20,000 of other income, so she's now got 120,000 of income. The $25,000 credit coming through from holding co, that also comes through, and she gets that credit against any tax she has to pay on that 120. So on 120, the estimated tax is 28,800. She's already paid 25,000, so she would have a small amount of 3,800 to pay in terms of additional tax. Her overall average tax rate in that case would be around 28.8% or 29, we've said here. That's taking into account the tax-free thresholds and all those sorts of things. So that's an average tax that she's paying at that 120,000 level. Under the new proposed rules, where we've got the trust at 100,000 of taxable income, the trustee now has to pay minimum 30% there. So we're going to have $30,000 of tax coming through from the trust as well. That, again, her taxable income will still be 120,000, but now because of that minimum amount of 30,000 paid, and the fact that she only has to pay 28,800 doesn't matter. She will be capped at 30,000. There will be no tax refund of the difference, of that about 1,200 difference. The tax is 30%. There is no change in that space. So that's effectively how it's going to work. So those on the slightly lower brackets are going to be penalised in that you are going to be capped at 30%. You don't get a refund on that excess. If you are above those average 30% tax rates, you may actually find yourself getting a benefit in this case, in that the tax has already been paid at trust level and you're only paying a smaller amount of top-up tax from that perspective. So there could be some benefit coming through, but again, it depends on a case-by-case situation for each family that we're looking at.
So that's a fairly...
Sort of
Sorry, Josh, you go.
This is the government's way of quietly saying we're stopping refundable franking credits that Costello and Howard brought in a couple of decades ago. This is their quiet way of unwinding it.
Correct.
Yeah.
And interestingly, they're not trying to deny it on a company tax credit that's coming through. They've not announced any changes in that space. So you would still get a refund if it was a company that was paying you directly, those dividends. But coming through a trust now, they are capping that and you will lose those credits.
Okay, so that example, it's almost parody, that there's a small disadvantage. If there was a lower amount being distributed, those tax free thresholds and brackets would mean that there'd be a bigger difference. That gap to the 30% minimum would come into play in a bigger way. I think for those who are over, as Sue said, that's a different scenario altogether.
Yeah.
So that's sort of an example. We'll be bringing out more and more of these worked examples for people, once we get details, and so that we can get some more scenarios into play. But that was just a basic for how the mechanics of this announcement is going to play through. Okay, so on to stamp duty, and another area that has been, I guess we've got this federal response to restructuring relief, but there's a little bit of a gotcha here in terms of the state-based tax in stamp duty, Suze.
Yeah, correct. So under the trust statement where they've said that we're going to have this time to be able to restructure out of a trust if we want to do that and avoid that 30% tax, they've said that relief will mean that we're going to be potentially exempt from capital gains tax and other types of taxes around what we would normally have when we're doing a restructure. But they haven't addressed the issue in terms of state-based taxes, and stamp duty is a state-based tax. It's different in each state. Some states have concessions for business restructures, some don't, most don't, to be fair. And so generally a restructure of a business out of a trust into another entity will incur some sort of stamp duty. So this could be a big area that people may get caught if they do want to restructure out of a trust into something else. This might be something that will catch them out and could cost a fair bit as well. We are talking in Queensland, I think it's about a 5%, is it? I can't recall exactly, but around 3 to 5% anyway on a business restructure that you potentially would have to pay in terms of the value of the business. So it could potentially hit people up quite significantly if stamp duty is in play. The federal government can't override state law, so the state governments would have to be on board with this to be able to say, yes, we'll waive stamp duty on these restructures. At this stage, all the states have been silent around it, and I guess are waiting to hear what the restructuring proposal looks like from the government. That means that we potentially, as we said, could have some significant costs still involved if a restructure is on the table for trusts going into a different structure over the coming years. And that is something we'll have to weigh up when we're looking at, Do clients want to restructure? Is it something that is more viable to do that from the tax perspective and avoiding CGT on doing that? But what is it going to cost us in the state system?
Yeah.
So yes, it's a very significant issue there, Phil.
Yeah, it is. And it's another one of those areas where, until we see all of the response, nationally at a state and federal level, they're material pieces of the puzzle for us to consider when providing advice on these sorts of matters. So we can't really, we really do need to see that extra information at a state level as well and see what the response is going to be there. Okay, CGT, so capital gains tax, again, for many in building and construction, has been a bit of a go-to if used correctly. So talk us through what the proposed changes are here, Suze.
Yeah, some big changes here as well. So the government has basically announced, and the big one is the 50% discount, which currently exists where you've held an asset for longer than 12 months, is going to be abolished. So at the moment, we can still apply the 50% discount up until 1 July 2027. So we have another 12 months. After that date, the 50% discount is going to be replaced with indexation. And some of you may be around and remember indexation from the old days when we had that in previously. Effectively, we're coming back to that. It's going to be a CPI-based inflationary rate that's applied to assets. So we're going to go back, I don't know. I remember the old days when we had tables and we had to go and look up the tables on the particular dates to work out what the CPI rate was to apply to the CGT and the gains and work all that sort of stuff out. We might be going back to that. Hopefully now with AI, we've got a slightly easier way of doing it than looking up tables, but we'll see. What they've also announced is that CGT will be a minimum 30% on any kind of real estate gain or real gain. So post-indexation, once the CGT discount drops out, you've got a minimum 30% sitting there on any gain. So whether your CPI gets you to that or doesn't matter. You're going to have a 30% tax there. It will apply to all CGT assets. And the big thing that we didn't see coming was it's also going to apply to those pre-1985 assets, which are currently outside the CGT system. So some people have been sitting on these assets for a very long time. You can imagine how much they would be worth now, having paid or bought them many, many, many years ago, and they are now going to be caught in the system as well. So if you sell those pre-85 assets before 1 July 27, you will still be exempt from capital gains tax. Post 1 July 27, you're now going to be caught in the loop. It's not all bad news. Our understanding is that you will have an opportunity to reset or revalue at 30 June 27 that asset, and that value at that point will be still exempt from capital gains. Or if you can apply the discount, you can still apply the discount to that gain up until 30 June 27 on paper in terms of your reset value. And then anything from that point going forward will be subject to indexation. And so there's going to be a bit of a tricky calculation for a while there where we're going up until 30 June 27 and then post. If you don't have a valuation at that point, it's basically going to be a time-based system. So up until that time and then post that time, we've got 50% discount. Post, we're going to have indexation kicking in. So yeah, quite a few changes in that space as well. Good news for small business, the CGT, small business concessions, will remain intact. That means that we can, on the sale of a small business, if we meet those conditions, we can still apply things like our active asset discount, our 15 years complete exemption rules, our super rollovers and small business rollovers. Those sorts of things are still going to apply. It's just now going to be a case of other assets that don't fall under small business concessions will have these issues come into play where we're now subject to indexation.
Yeah, so we're almost, and I think this is a point we've had quite a bit of discussion, and you've mentioned already, Suze. For many people, there is going to be the ability to take some time to process the information as it comes out and make a calculated decision, with your advisors on how you want to travel forwards. One of the areas, though, because of this, this deadline of 1st July 27. There will be some people who may feel that it's the right time to take advantage of the 50% discount in full. That they may have been, holding back on, pushing the button on that, but that may factor in for some people who really that is a much better option than what things look like post 27. Again, though, that's a really case-by-case sort of situation. And all of this needs to be looked at, not just with detail, but with what the comparison and the scenario is going to look like in terms of what the go-forward position is. So, but we do understand.
On the discount versus indexation, it is actually possible for the indexation to be better than the discount long term. On a moderate returning asset with moderate CPI, it can actually be to your advantage. So it's not downside here.
Yeah, exactly. And following from Phil's point as well, those people that might be sitting on pre-85 assets and you were thinking about potentially selling in the next few years, this might be the opportunity to do that prior to 1 July 27. But on the same side, if you weren't planning to sell, it might not be a terrible outcome to hold it a little bit longer and sell, say, in 2030 or 2035. So again, it's going to be very case by case, running individual scenarios to work out whether you are going to be better off moving an asset now if you were planning to versus waiting, say, 5 or 6 years and moving it in the future at some point.
Yeah, we're certainly moving to a position where things are going to be a lot more nuanced and it's worth modelling out the different scenarios, moving from where we are at the moment, where a lot of the time these sorts of things are a bit more cut and dried. Okay, so Josh, I think we're coming to you now. We're going to talk through, I guess, when we're looking at negative gearing, the sort of different scenarios that are going to play out, and particularly from a timelining perspective as well. So take us through negative gearing.
Take us through it. We're not going to get too negative about negative gearing today, guys. We're just going to talk through what it means.
Is that accounting humour?
It was some accounting humour. It would have been lost. It was pretty bad. So there's a few different cohorts on here as well. So I sort of want to make the distinction that this is realistically around where people are creating assets and holding them in investments. So we know our building construction clients, a lot of them are actually builder developers. And so there is some interesting nuance in this negative gearing, which we need some more detail on from the government, because developers, I'll just make this point quickly, developers that are holding property and creating property, they're typically not holding that property in the same context of the capital gains regime. They sort of hold it like trading stock. And so the tax system applies a little differently to that. And we do need a bit of clarity from the government on sort of how narrow or broad this will be. Now, the other overarching piece to the negative gearing here is they're focusing on residential property, right? So we'll carve out commercial property and put it to the side, because basically the negative gearing changes don't apply to that. They're really just laser focusing in on the residential piece. So we've got a timeline broadly from sort of 12th of May or before 12th of May up till the 12th of May and up until 1 July 27. And we've got these 4 core buckets that people will sit into in terms of how the negative gearing does or does not impact them. Or how it might limit present day or in the next couple of years the benefit of negative gearing. So let's look at bucket 1. We'll just work through it 1 to 4. So if you've owned your investment property up until budget night, the core part of this is it's grandfathered. So there's no change to the negative gearing setting that you currently have and that benefit attached to those properties. That change only really happens when it's disposed. It's not really a you problem, it's the next person. If they're buying it from you as an investment, it's the next person. And that jumps to bucket 3, but I'll get there. So bucket 2 is you've bought it between budget night and 30 June 27. There's a transitional period, so you essentially get 14 months of negative gearing that you can benefit from, and then Josh disappears. Dear. Josh has just moved house, and he promises me that he had a fantastic fibre put into his fibre connection put into his house. I hope that that fibre connection comes back into play again sometime soon. Suze, do you want to pick it up from here and talk through bucket 3 and bucket 4?
Sure. So, yes, effectively negative gearing, as we're just talking about. Bucket 3 means that anything that is established or bought after 1 July 2027, losses will be ring fenced. That effectively means that you don't lose them entirely, but they will be deferred and you can only apply them against any rental or property gains in the future. So that means either the property becomes positively geared or you sell the property for a gain, a capital gain, and you can then offset those losses at that point in time. So they just get deferred effectively. It also, though, having said that, if you've got other property that is positively geared, you can offset those losses against that property as you work through those things as well. So effectively, we're just ring fencing or keeping those losses in a little bucket and pushing them forward with the property or other properties. Bucket number 4 is into relation to new builds. New builds means that that you have to be building a new property. Can't be that you're replacing property. So if you buy a block of land, knock down a house and build a new house on it, that won't count. You have to effectively knock down the house and build 2. So you're increasing current stock of housing. If you're doing that, a new build comes into play after 1 July 27, you can actually claim the entire negatively geared amount as you go throughout the life of that property. So it is an incentive that the government's throwing out there to try and bring new supply into the market and try and fix their housing problem. So yeah, it's definitely something to keep in mind and looking at where you fall in relation to each of those buckets. Welcome back, Josh.
Well, that was interesting, people. I went on a random journey. I didn't smoke, by my promise. I'm back. Okay. Where'd you get to, Suze?
End of bucket 4.
Yeah, just finishing off bucket 4.
Good stuff. Okay, that was a journey. Okay,
so let's pick up from where we were there, and we're going to talk about what is quite a carve out in terms of these changes, which is around how new builds will be treated. So, Josh, you want to take us through this part?
Yeah, this is, in particular for our building construction clients, this could be an opportunity in sort of waiting as well. So it's the new build advantage. So I won't do this sort of in a bit of order because the concept of this is there might be a bit of a redirection of capital towards new construction. So if we're building new properties from 1 July 27, we've got all of the current present day settings around negative gearing. You get full negative gearing. You get to keep the CGT discount on new builds. It just basically looks like present day negative gearing for a new build from 1 July 27. Now, it is interesting. Treasury did actually have commentary around this budget announcement saying that the supply of new builds is actually going to decrease as part of this, which is kind of an interesting counter to the whole announcement in the first place. However, there is an advantage. So if you look at this as an opportunity, particularly those who are in the new build space, there could be particularly investor type product as well. So I was going to talking about, custom architecturally designed property, because that's not sort of, whilst you'd still get it, they're typically not the best stock for investment. So we're talking about investment style. So this could be a good, as we say, a tailwind for those businesses that are actually producing investor grade new builds. So there could be a good advantage to this as well. And the key thing is it really does need to be new stock, not replacement only. And we'll get to that actually right now in terms of what's in and what's out. So because there's going to be many questions around, what if I do this? What about that? So let's have a look. So what's eligible? The stuff that you would expect to be well and truly in the green zone. If it's an off the plan brand new apartment, that's a new stock. A knockdown to a duplex. Now I want to just make a point on this one. This is probably the core one. Is a knockdown rebuild is very common, particularly for a lot of our clients on the call today who are doing developments, their own work. It needs to actually increase the residential stock to the overall community. So if you're just knocking down one property and building a brand new freestanding single dwelling again, that's not going to count because you haven't actually added to the residential stock. You've just replaced it. So the key thing there would be you'd be knocking down one and building a duplex or two homes. That would be increasing stock. So that's falling within negative gearing under the new build. So you get all the benefits again. Building on vacant land, as you'd imagine, brand new land, you're building new stock, fine. The granny flat, I've had a few questions around, can we do a funny maneuver with granny flats? Short answer is no. If you're basically annexing to an existing established property, no, you're not going to mystically change the setting on negative gearing for that. The other key one as well is, particularly if you're building it and then you're selling it as well, there's this 12-month period. So the subsequent investor that buys it, it needs to still be new. And so they're sort of using this 12-month rule in terms of if it's been occupied for less than 12 months, we'll still count it as new stock for the next person that buys it for the purpose of negative gearing on the next person. But if it's been occupied for more than 12 months, it's now falling away from being new. So it'll fall into the existing residential property. So just be very careful of that as well. If you're buying something that is fairly new, but over 12 months, that could be a trap if you're buying it as an investor.
Yeah, there's a hard stop timeline there in terms of the clock, getting to 12 months. Okay. Okay, so then, so they're the kind of, they're the core changes that we've seen come through the other night. A little side note too, that we note that a number of changes come into effect before the next federal election. And in the budget reply the other night, there's promises from the opposition to remove any changes that are coming into place in this space. We're going to stay outside politics. We're going to focus on information that we have in front of us that we need to kind of process and consider when making decisions and helping clients in that space. And we'll have to keep doing that because it looks like this space is going to change over time and continue to change materially. So they're the core changes that have been announced. Yeah. Josh, just some of these other additional measures that have been announced that are relevant too. Thanks.
Yeah, let's just talk through this as well. Now, we can stop holding our breath on this instant asset write-off looming deadline that kept coming at us for a few years. So, they kept extending it. Finally, no more cliffhangers. They're just locking it in. Instant asset write-off, 20K, locked in. No more sort of holding our breath year to year. So that's through the announcement. That's a good maneuver because we're not sitting there second-guessing ourselves on whether they will or will not extend it every year.
Or writing the same article every year.
All the same, every year they've extended it. So, which is good. So it gives a bit of certainty for small business. I'm buying sort of assets if they need to buy assets for the business. I'm always of the view that unless you need to buy it, don't go burning business capital just to buy assets for the sake of a instant asset write-off. As always, the 2-year loss carryback returns. This might be quite important for our clients, particularly in building construction that has quite ebbs and flow years as well. And the concept of this, without getting too complicated with what it means, is if you've sort of had a few good years and paid a bit of tax, and then third year, as an example, you've got a year which it just hasn't gone to plan, and you've got losses. The idea is that loss can actually carry back into that prior year that you paid tax and claw back some of that tax. Those who've sort of been in business for quite a number of years might remember that the loss carryback did exist. Sort of nearly a decade ago. For a few years, that was out there as a bit of a stimulus back in the day. They're sort of bringing that back, essentially. So this could be quite a good tool for businesses as well.
I think when there's volatility in construction as well, there will be 100%. Some operating in the space where they have better years than others. And so that measure, I think, will be, open to use, for a number of businesses in our space.
100%. I think it's a good flexible sort of element, which is good. There is some apprentice changes as well. I'll just really quickly cover off on it that the existing one's going to be a bit restructured. The apprenticeship program will actually be a bit more targeted from January 26, which is sort of already sort of in this period, to really focus on construction trades. Obviously, they're trying to incentivize people getting into construction so they can, by extension, increase supply, blah, blah, blah. You can see what they're doing there. They will be favouring small to medium employers. So you sort of get, if you're a smaller sort of operator or medium operator, you'll sort of get priority to the incentive programs, and the bigger operators fall after that. The other one as well is this, our first tax bracket, or technically second tax bracket, but the one that actually tax applies. So the 18,200 to 45 bracket. There's going to be a 2-year slide down of the tax rate. So it's currently 16% applies to that tax bracket. over the next 2 years, July 26, July 27, that's going to ratchet down to 15 and 14. So that will be not just for low-income earners, everyone that's in the tax system will be a little bit better off in that tax bracket.
Yeah.
So,
that kicks in for everyone. So that will be a bit of relief.
a little bit, yeah.
Okay, so we're going to move now. I guess this is sort of starting to sum up a little bit, and just having a think about a timeline for how each of these changes may start to unfold. So, from a timeline perspective, that we almost kick off with this negative gearing cutoff as of the budget announcement the other night.
Yeah, if we're basically from now, or 12th of May, if we're buying established property, that's a hard cut-off at this point, hence the red box as well, just to warn you that is the case now. Then just sort of flowing through 1 July, sort of now onwards, that instant asset write-off and carryback will be in play. According to the announcement, again, we always have to caveat, we're still waiting for legislation to lock in. I expect those pieces would be locked in, but until you know for sure. Instant asset write-off, I'm more confident on. The loss carryback, we'll just have to wait till they legislate how that's going to work. Then really, a lot of the core, the sort of more hardcore changes to this really kicking from July 27. So I want to make that point that the July 27 is really the core date for the large majority of the big swinging changes to come into effect. So July 27, that's where the CDT and the negative gearing is really starting to impact people, and that's where the restructuring of your business. So this is around the trust thing. From July 27, they're opening the gate to a restructure. We're still trying to work out exactly what they mean in terms of how they're going to have concessions and flexibility on restructuring. We're not entirely sure what the opening of the gate looks like,
and the state-based concessions might look like by then as well.
Correct. The states will try to work out their stuff as well, whether they're going to do stamp duty or expand. And so the key thing from July 27, if you've in the negative gearing space, you're sort of ring fencing your losses ongoing. Now, the key point I just want to flag in everyone's mind, whilst you can't get the immediate tax benefit of the negative gearing losses, they don't evaporate. They do just basically get ring-fenced or quarantined until such time as the property is positively geared or you sell it and make a capital gain. So it's a quarantining of losses. It's not a evaporation of them. It just defers your tax benefit until a bit later. 1 July 2028, the 30% minimum trust tax, that's going to kick in. So again, we've got a number of years to think about whether we do or do not restructure groups. There's a bit of time, but that's the timeline. And basically, by the time we're at 30 June 2030, we've worked through all that piece, and that's where the door is going to be closed again on the restructure relief piece. And that's sort of our broad timeline of how this will flow based on how it's been announced. So we will see in the detail in the coming months.
Okay, so I'm going to just put up this poll now, and then we're going to go into some questions. So this poll is, as I mentioned at the beginning, if you did want to catch up with us and speak to one of the team about any of the services that I talked about at the beginning, so outsourcing bookkeeping, whether you want to talk to someone about our fractional financial control service, so where we do the heavy number crunching in terms of producing monthly reports and that sort of stuff, talk to you about margins and the like, engaging a fractional CFO, which is very much about that ScaleX product, and scaling either the revenue in the business, so you can go from, say, a lot of those clients are on the journey from 5 to 50 mil, that's their journey, or they're happy enough at, say, 5 to 10, they just want to improve quality of earnings coming out of the business. That's what the fractional CFO service is all about. And then obviously, if you want some assistance or would like to unpack things from a structuring perspective, there's that option there as well. I'm just going to leave that up there while we get to a few questions. So, Suze, there's this question around buying, so a company owning property, and what are the changes that might come into play where it's a company as opposed to an individual or trust. So maybe if you want to cover that off.
Yeah, it's a really good question, and it does have some nuanced answers, to be fair. Depends on if the company owned the property prior to 12th of May 2026 and it was negatively geared, nothing changes. You'll be fine in that space. If the property, again, going through those negatively geared options that Josh put up before, depends on when the property was purchased, that's going to apply to a company, a trust, whatever. So yes, a company could be impacted if that's the case. If it's in relation to a capital gain on the eventual sale of that property, companies did not get the 50% discount anyway on capital gains. And so you could actually end up in a better position where a property is owned in a company with indexation in place, because you do or will get that uplift in cost base that you would not have previously had. So you could actually find yourself with a bit of a windfall there, where you've got property sitting in a company. So that could actually be a better structure for you. But again, you really have to just look at it from a personal perspective and your personal circumstances in terms of what you're using the property for, how it's being used. If it's a development property instead, you might actually not have a capital gains issue anyway. It might be subject to income tax. So again, we just got to weigh up what that specific scenario looks like and how that company is applying whatever that scenario is. So yeah, so great question though. Really, really good question.
Yeah.
And that equally actually answers Simone's question about builder developer. Just quickly, whilst I saw that on there, Simone, around new residential stock.
Yeah.
If you're a builder developer, you will be out. Typically, you're outside the CGT net anyway, so the discount is kind of irrelevant if you're a builder developer doing it as a business generally.
So I just have put this slide up now. These are one event that's coming up, one event that's just passed. So but we're talking budgeting at the moment. We'll get to a few more questions in a sec. I just wanted to sidebar on this. We're talking about federal budget. What about your own budget in your business? So we will be running this in June, early June. Not a bad time of year to be thinking about what your financial year, your FY27 budget is going to look like in the business. But then also, importantly, what sort of discipline do you need to have from a forecasting perspective? So forecast cost to complete in a job, and having that happening across multiple jobs, how are we going to look in 3 months' time, in 6 months' time, factoring in all the known knowns in the business and trying to work out, I guess, where we're heading so you can make much better decisions. So Dave, one of our partners in our advisory division, will be running that one. The other event that I've got there is our Express webinar we ran the other day on Payday Super, just another change for us all to deal with. Coming in at 1st of July. So head across to our resources page if you want any information on any of our previous events, and check that Payday Super out because it's something that we're all going to have to deal with. In terms of other questions, I mean, there's a little bit of talk, Josh, in the pub about, companies are going to be heaps better than trusts now. We should all move over to companies. There'll be a lot of those kind of general statements being made. I don't think it's that simple, right? Usually isn't.
No, it's not that simple. It's a whole it depends scenario, and the range of variables and scenarios has just got bigger in terms of how we have to approach this. And one thing I typically look at the trust versus company scenario. And funnily enough, I, before the webinar this morning, was doing this exact piece of modelling with for a client on whether they should be buying a property in a company or trust as well. And the key differentiating factor that you will typically come back to on this is how are you funding your contribution to the purchase of that asset. So if you've had great years in your construction company, and say you are operating in a company and you've been paying tax at 25%, and you want to use that money to buy property, that can be a particularly big determining factor, whether trust or company, because it's common scenario where, as an example, if you're pulling some of that money out of that company and putting it into a trust, you might find that the issue around director loans or Division 7A, which is another tax provision, can actually outweigh the benefit of capital gains discounts and indexation. And so it all very much depends on how you're funding the asset. What's its actual purpose? What's the long-term goal for it? Is it short-term, long-term? Is it broader generational wealth creation or not? It's going to depend on a number of factors, and I've proven cases in the last week where a trust has been better and a company has been better. Both equally had their merits in each individual group circumstances. It's a very interesting one, and unfortunately, it makes it a little bit harder to navigate these decisions. So the key thing is you need to ask more questions of yourself and of advisors up front. Advisors need to be asking more questions so you can establish it, because unfortunately, given stamp duty in this country, you can't take these backsies when you put a structure in place with a property in it without a massive cost.
Yeah. And I guess there are some nuances as well from I mean, we've been talking mostly around the tax component, but from an asset protection perspective, there are nuances from a company to a trust as well that we need to dial in. And, given, you have, people doing lots of different high risk sort of activity like developments and the like, that we do like to have some protection in place as well.
Yeah. So what I've found as well on this, everyone, and Phil, is it's actually going to broaden or sort of expand the horizon in terms of what we're thinking about, because some of these changes actually make us think about whether we, particularly if we're building long-term wealth, we need to have a look at our estate planning again now. That actually will impact the long-term outcome, given these new settings around trusts, etc., and how this will flow. So I think that you're going to see some changes in thought processes on how we structure our estates and how assets are directed or held in estates, because simple concept, guys, is trusts don't form part of a estate. So if you've got stuff in a trust, it doesn't get dealt with by your estate. Whereas if you own shares in a company personally, well, that is part of your estate. So it'll be very different. It's very nuanced.
Yeah, and I think any tax planning that's going on at the moment, and thanks to the Treasurer for announcing these changes right in the middle of tax planning, the peak time for accountants to try and work with clients in any case. But look, we're not financial planners, so we can't advise people around things like SMSFs. But Suze, I expect as well that given the carve out around SMSFs, that may also, Josh is talking long term. If we take it a bit back from death to retirement, that people, we have a lot of clients in their 30s making good in construction at the moment, and that that sort of scale of thinking may not be factoring at the moment, but given some of the changes in the tax settings now, those might be things that people want to start to consider in a bigger way.
Yeah, correct. We have a lot of clients, in their 30s or even slightly younger, that have traditionally not even considered super as an avenue for tax planning or wealth creation or things like that, because a lot of people around that age think, I'll think about it when I'm closer to retirement. It's not something I want to worry about now. And they can't get their head around, well, if I put the money there now, I can't use it for another 30 years or 40 years or, whatever it is. So that could be a huge impact in terms of what we're looking at and where people start to change their thinking over the coming, few years in terms of utilising something like an SMSF a lot more. Because they will have these much greater tax rates that they can apply, and it's much, much more effective environment potentially going forward. But again, it needs to come into the holistic approach of how you're looking at everything from your wealth creation to your trading strategies to your tax minimization strategies. Like all of it comes into play as a holistic type of view. So yeah.
And a fun thing here as well, guys. I'm going to put a pub chat to rest if it comes up. You own residential property. You think you're clever players to buy it from yourself in super, that's not permitted. You can't buy residential property from a related entity in super. So sorry if you thought that was a clever maneuver.
That's right. But there are plenty of other clever maneuvers, and there are there are options I think that are going to be more available to us now because of the changes that are coming through. One thing I think we probably just needed to just cover off just quickly is this difference between discretionary trusts and a fixed trust, and because there's a different treatment around those two different entity types. So, Josh, what's a fixed trust, and what are the challenges that come into play when we want to use an instrument like that or entity like that?
It's a very interesting structure, a fixed trust, because a lot of the time fixed trust and unit trust get used interchangeably as a phrase, but they're actually very different as a concept. I think there's possibly only about 6 true fixed trusts in Australia. Mostly because, so let's just talk through it. So the unit trust, there's some element of flexibility still in a unit trust. And so the trustee usually has discretion to change some settings in it or make some changes to the way units are issued. A fixed trust is very much locked down, very, very narrow. The trustee basically can't change anything to do with the unit holders, their rights, etc. And so a fixed trust basically nearly operates like a company, to be honest, in that you've got fixed people who can benefit from the trust, and they are all identified upfront, can't be changed, and you're locking it in. Now, that might have utility as well, because trusts still get access to things like indexation, etc., but you have locked in your beneficiary pool that you can't change. So proceed with caution on fixed trusts. They're much more complicated than what they might appear, and the government or the tax office has actually properly tried this through, I think, federal court before on colonial back in the day to prove that it has to be very narrow. So don't think fixed trust is this mystical thing that fixes it.
So there's some exemptions there around fixed trust, but beneficiaries have to be named and can't be changed, and the proportion of holding is stipulated as well and can't be changed or amended. Essentially, the whole thing has to be blown up and start again. And obviously, then there's all the implications that come from that. So, okay, we are at time. It is 11 o'clock. Thank you very much, everyone, for joining us. Like I said, if we didn't get to your question or if there are other questions that you'd like us to answer, we're going to release an FAQ document. We keep your eyes peeled for the part 2 of this. We'll run this once we have some more detail. We've got some clarification around legislation. We don't even have the legislation yet. We've just got announcements. So we'll be running a second part of this once we have some more detail. As always, if you need a hand with any of the things that we look after, please reach out. We'll be coming back to those people who put their hand up for a consultation over the coming days. So we'll be back in touch with you soon. And stay safe out there. It's a bit wet here and there, so please drive carefully on the roads out there, and look after those people around you. All right, guys. We'll see you next time around. Thanks, Suze. Thank you so much. Thanks, Josh.
Thanks, everyone.
And we'll see you all sometime soon. See you later.
Everyone.
Bye.